You're listening to QSBS Solved, where we share insights for founders and investors looking to maximize their business's growth, exit opportunities, and tax savings. Our team at QSBSrollover.com offers specialized services to help you benefit from owning qualified small business stock. Our podcast guests are leaders in their respective fields and work on every side of the startup journey to help founders and investors win. The ideas and opinions shared here are not investment, tax, or legal advice. Reach out and we'd be happy to connect you with a qualified advisor or tax counsel. For now, enjoy today's episode. Hey everyone, welcome back to another episode of QSBS Solved. I'm lucky to be joined by the co-founder and chief strategy officer at EquityZen, Phil Haslett. Phil, thanks for joining today.
Yeah, thanks for having me, Brady.
Yeah, I had mentioned maybe when I talked to Andrew from Acquire last week, he was saying that he was stoked on QSBS and he was like, I love QSBS. And you kind of said the same thing when I reached out to you. You were like, man, QSBS is my favorite. So we love to hear that. Why don't you tell the audience a little bit about what EquityZen does? Many of them are going to be familiar, but then we can dive right into it.
Yeah. Well, there's at least dozens of us out there that are really excited about QSBS. So
right.
hopefully it's more.
Handfuls and handfuls.
Yeah, exactly. So happy to be here. As you mentioned, co-founder, chief strategy officer of EquityZen. It's a platform for secondary liquidity for private companies. So best way to describe it is like an example. If you were an employee at, say, Uber or Lyft in 2017 or 2018, you were watching your net worth grow pretty considerably on paper while the company was growing in valuation, but you couldn't just kind of go into your Robinhood or Fidelity account to sell shares. It was a bit more difficult to get liquidity. So we built a platform to connect those shareholders with investors that wanted to invest in the next thing. And those investors were going on to Fidelity and Robinhood and typing in Lyft, DocuSign, Coinbase, and they couldn't find them. And then they ended up at EquityZen. So that was kind of the impetus for that's basically our business model, what we do.
Very cool. Is there, and if I'm ignorant to this, tell me, but is there a platform that blends the two, like private markets and public markets, where you actually could do both in one platform? Is that a vision for EquityZen, or I don't know?
Not really. I would say it's probably a vision for like public brokerages, right?
Mm-hmm.
If you're Robinhood or you're E-Trade or something, you probably get inundated with inquiries about people that want to sell their private shares or buy private shares. And so thinking about building that into your flow is probably a long-term goal. So I think starting in public and then adding in private is probably a little bit easier than the inverse, is my guess.
Well, give me the sense of the scales annually, because I was just thinking as I was talking, it probably is it's like a rounding error for Schwab or Fidelity. It just like doesn't matter to have the private markets on. You guys are obviously doing a great business and you have some competitors who are as well, but the volume, what's the volume like annually?
Yeah, it pales in comparison. If you think of just the addressable market, you kind of look at the market cap, right, of unicorns, like companies worth over $1 billion. I think that's probably like a few $1 trillion. And the turnover rate of that few $1 trillion is probably in the single digits. So even if it was, 5%, you're looking at, $150 billion a year that probably transacts. And that's probably generous. And part of that is just because there's no real exchange to cross these things and close. You can't do super small trades, right? Like at EquityZen, we do like $10,000 trades, and that's probably the lowest of the low end, which is a good breakthrough, right? It used to be millions of dollars at a time.
Sure.
And so, it's like, compared to volumes that happen on a daily basis in like a crypto market or a public stock exchange, which are, probably in the trillions, like it's a rounding error, like you said.
Yeah. Well, but it's a really cool business because it's one that your average American just doesn't even think about existing, right?
Yeah.
Like they think of stock and they think of public companies. They don't think of private companies. They don't think of shareholders of private companies. And they certainly don't often probably think of a marketplace where those are traded. But within the startup ecosystem, within the venture ecosystem, the angel communities around the angel investor communities around the country, it's a massive outlet. What's the breakdown between I want to say demographically, but like the type of investor that you see between employee, founder?
Yeah. So I kind of think of them on the two sides of the market. Who are the people buying these shares and who are the people selling? For people selling shares, it's primarily employees ex-employees and early investors and founders of those
Yeah.
private companies. The investor demographic is typically tech-savvy, self-directed investors that make a lot of public investments. They make alternative investments, and they've become aware that you can make these private investments into pre-IPO tech companies, which kind of makes sense because, I give this fun little factoid that when Amazon went public, I think it was 1997, it had a market cap of like $450 million with an M, right? And so the day after that, a lot of public investors now had exposure to Amazon when it was like this tiny little thing. Right now, it's $1 trillion plus company. And so you participated in the upside of this company along the way while it was public. And if you fast forward to 2025, you've got OpenAI worth $500 billion with a B as a private company. And so if you wait to invest in that company once it's public, I mean, there's really like only a little bit of upside on their way to being the biggest public company in the history of the earth, right? $4 trillion or something like that. So
Sure, right.
I think there are investors that have observed that their old portfolio had exposure to this upside growth in tech and the risks, right? These are high risk, high growth investments. And have wisened up to the idea that you can invest in this space. So it's typically individuals, some institutions as well, that are buying in the space.
Yeah, I just saw the not to be a news podcast, but I just saw today the Databricks sounds like leaking the $100 billion valuation on their next raise, which is, yeah, I mean, these it wasn't that long ago when you just wouldn't see a B next to numbers like that at this stage in these types of companies. What obviously, I'm sure Databricks is on EquityZen. Maybe they're not, maybe they are. But that's the size that I think of. How small can you be to come on the platform and say, hey, let's see if we can get some liquidity?
Yeah. So it's a function of two things, right? One is the size of the company, because there just needs to be enough market awareness of who you are as a business. Someone needs to have read about you or heard about you or your product or used your product. And so typically the companies are like north of $1 billion in valuation. But the other important aspect, since it's mostly secondary trading, which means someone has held the shares for a while, is that the company has to have been around for a certain period of time. If a company is only 2 years old, there aren't that many employees that have felt some type of illiquidity pain, right?
Right.
If you were issued shares and a year and a half later they're worth a lot, you're not going to the company saying like, hey, when are we going public? What's happening?
Right.
But if you were an employee at SpaceX, which has been private for 20 years, this might be a question that's really prevalent. The time for companies going public, as I think most people know, has gotten longer and longer. And so it becomes a pervasive issue. But I bring it up just because in 2025 era, you have companies that are becoming $5, $10, $15 billion valuation companies in a matter of like 12 months, 18 months, mostly AI businesses. And so while there are investors clamoring to invest in these companies, even at these like pretty big valuations, there might not be that many people that have a liquidity need. So it's really a blend of valuation awareness and how old the company is.
That's the fascinating thing about the AI moment. You mentioned OpenAI being, you looked at as a $500 billion company. And if they just like 6X, or they'll be right up there with the most valuable.
Yeah. Then they're NVIDIA, right?
It's like, just 6X, whatever.
Yeah.
But I don't think we have no idea about what the ceiling is on the valuation of some of these companies. I mean, it could very easily 20X from here. And that's just like the new normal for this.
Yeah, it's a known unknown, right? Like
that's right. Yeah.
You used to see in venture that the question you'd be asked is, can this be $100 million a year in revenue business? If so, then it's kind of venture backable, because there's enough upside because I'm coming in at a $20 million or $100 million valuation.
Yeah.
And I don't really know what the new question is, right? Because I don't think you're venture backable if you say, if we really kill it in 10 years, we're making $100 million a year. People are going to be like, Lovable did that in like, 5 days. Yeah, I don't know what it was, 6 months. It's like, so there are certainly new targets to aspire to.
Yeah. The solo founder, the small team, the lifestyle business, all of that's going to have a revival here, because people are going to look at, hey, if I go the venture route, what size does our company need to be for anyone to care about it? Which obviously you and I both know that there are amazing businesses built that never get close to $1 billion, even $50 million in value. And so,
and they're great businesses, right? Like I think, you just had somebody from acquire.com. I'm sure there's like plenty of just good, sleepy old businesses that are going to end up selling themselves for, a paltry 10, 20, 30 million bucks, but the founder owns almost all of it. And I got to tell you, that's probably a better exit than a lot of founders that take their company public. So
yeah, I mean, you have the shiny press release, but then, how much ended up in your checking account at the end of the day? Sometimes it's none.
Exactly.
And the solo founder, maybe bootstrap founder, was better off. Very, very interesting. I wondered too, we're sort of in the AI craze. I wanted to ask you about how you guys are using it internally at EquityZen. Maybe there are some things you can and can't share. Is there anything interesting beyond maybe like making go-to-market or marketing or those kinds of things a little bit easier? Is there anything beyond that you can talk about?
Yeah, nothing. I can't share too much, but it's obviously a topic of discussion. I would say the quickest value add you can have as a business, I think, is just encouraging people to leverage AI for their own day-to-day tasks, not necessarily how you interact with the customer, but how you're doing your own work behind the scenes.
Yeah.
We're in a heavily regulated space. We're a FINRA registered broker-dealer. We have an investment advisor with the SEC. There aren't clearly defined rules on how you can operate and use AI to interact with your customers yet. But there are some rules in place on what you can do behind the scenes to be of service to your customers, right? So customer asks, what are the 10 companies that you've done the most volume in the last 12 months? That used to be a bit of like an exercise of going through the database and summarizing things, putting together some nice charts. That now can be something that you can use an LLM to prompt your data lake to have a much quicker response. So we've just been encouraging our team to do that more and more to help refactor code, things like that.
Interesting. Yeah, that's good. I mean, there's like the low-hanging fruit, and then there's the stuff that everyone's working on internally and kind of safeguarding, saying, hey, this is going to really, 10x our strategy over the next couple of years. And I mean, we're doing the same. Folks we talk to, I'm sure, are too.
Yeah.
Maybe some trends you can talk about in terms of volume, trading activity and volume on your platform that have been interesting over the last, let's say, couple years.
Yeah.
Because we're sort of in like a elastic economic moment. And so just curious because, 2-3 years ago, we were saying, the venture market is asleep now because we were coming out of the 2021, 2020, that kind of era. And now things seem like they're stabilizing again. What kind of volume changes have you seen? Anything interesting to note?
Yeah, for sure. So we've been doing EquityZen for about 12 years now. So we've seen a couple different kind of market evolutions. Yeah. I'd say much like a lot of other investment related businesses, 2021 was really a crazy time, meaning really, really high, borderline absurd volumes and investor interest. That was a function of being stuck at home, zero interest rate environment, stimulus checks. And so what you might have observed on things like the GameStop frenzy transpired down or, trickled down to other markets, including EquityZen. There was just a lot of excitement, speculation that happened. And similar to what you saw in public markets after that, 2022 to 2024 were relatively slow, right, for secondary markets and for venture writ large. What I think is interesting in 2025 is clearly public markets have performed really, really well. There's a lot of excitement and bullishness on this AI revolution. But if you actually strip out the top 7 or 8 companies that have raised venture money in the last 6 months or so, venture is pretty much flat, if not down. And so much like in public markets, where most of the return is driven by Mag 7, you kind of have a similar analogy for private markets, where most of the capital being raised and most of the activity for primary capital raises is amongst, whatever people want to coin the private Mag 7 is. And that's OpenAI and Anthropic, Databricks, and a handful of others. And so it's one of those reminders that we talk about how this whole space is booming and it's enormous, but it's actually heavily concentrated amongst a couple of companies. And the same is true for the NASDAQ, right? You strip out NVIDIA, Intel, Microsoft, Google, Meta, returns are like okay.
That's right. Yeah. I mean, people say that, venture is booming in Austin and Denver and Miami and these places. And we focus a lot on New York and California, doing QSBS type work. New York is very large, but there's still only like 12, 15% of the US venture market. Obviously, California leads. And I see the same thing in the data. It's like there was, $1.3 billion of capital raised this month in the New York ecosystem. But, 900 million of that was 3 companies raising mega rounds.
Yeah.
That leads me to ask, is there a lot of trading that you see happening on the platform, like short-term speculation? I'm thinking about Databricks, where their last round was whatever, 62 billion. This one looks like it's going to be 100. You could potentially buy stock and then a year and a half later sell it back into the platform. Does that happen a lot? Is that a pattern that you see, or is this mainly people trying to buy and hold?
Mostly buy and hold for a couple of reasons, but I'd say the main one is you can probably think about the private secondary markets looking more like the real estate market. Transaction costs are pretty high. Times to close take a long time. And therefore, it's kind of in your best interest to get into these investments thinking you're going to hold for many, many years, similar to buying a house, right? Which I think the general rule is if you're not going to be living in this house for more than 4 or 5 years, or hopefully more, it probably doesn't make sense to buy because your cost to close and then your cost to relist and sell are really, really high. And that is the reality now. I mean, like the market has progressed a ton, but there's no true exchange for these things. There's no clearinghouse. There's no tickers. Like we have them, but we created them. So there isn't even like standard set of, what you have for public companies, ISINs, QSIPs, sectors. Like we have them, we provide them. We actually provide them to Yahoo Finance because Yahoo Finance wants to have a bit more visibility on private markets. But there's no like kind of standard of care. And so there isn't too much flipping going on. It also like heavily irritates private companies. I think the general sense is secondary liquidity or Databricks, we kind of get it. There are people that have been here for a long time. We're going to address secondary liquidity where maybe someone buys their shares every once in a while and they're a new investor that's here for the long term. Or we're going to run what's known as a tender offer where we're going to address secondary liquidity in one big fell swoop, right? And so that's kind of what we see more often than not.
Yeah, super interesting. When you look back from starting EquityZen to now, how has the regulatory environment changed? I mean, you just kind of mentioned that it's still not incredibly mature. Maybe the regulatory environment may be, but I guess the infrastructure around the markets isn't as mature as it could be at this stage. How has it changed in the last 12 years, and where do you think the most progress can be made to do some of the things that you were just talking about, like standardization across the industry?
It's definitely gone in the right direction. So for one, you just have more awareness that this is even a thing you can do, right? When we started in 2013 and we were talking to prospective investors to buy shares of whatever was popular then, probably Palantir and DocuSign.
Yeah.
People just didn't even know you could do this, that you could buy shares from a selling shareholder of a private company. So we've grown a lot from kind of evangelists and people that do this like hobbyists, really, and it's grown to more market awareness, which is good. Infrastructure has gotten better. So we built our own full infrastructure to handle transactions, settlement, money, KYC, AML, and those have driven down costs, which has been great. Where it could go, it kind of depends on what companies want. Some companies are private because they want to be private, and so they might not have as much interest in a stock exchange where my shares have a ticker and are listed and there's liquidity. They'll wait to do that when they're public, if they ever go public. Other companies are really embracing the idea, which is, if there's a secondary market and we're supportive of it, then our employees, who are our most important asset, are getting true value for their shares, right? There isn't some huge illiquidity discount. We as a company know what the public kind of thinks we're worth. So if and when we go public, we kind of know how to price it. So it's really, it feels like it's always at a bit of a crossroads where you've got some companies that are like, secondary markets don't really help me that much. My employees love it here. I don't need to deal with it. And you got another group that says, this is fantastic. It should grow and should be more prevalent. And so it's kind of hard to tell. I'd say from a regulatory environment, things have also improved. There's changes on the accredited investor definition, which allows more people access, which I think is generally a good thing. There are some changes made to 401k access, or at least purported to be 401k access, which I think will open up and unlock a whole new pocket of investors that can use capital that they're not going to touch for a while anyways, which actually fits really well with illiquid investments.
The self-directed IRA sort of infrastructure that's developed over the last 10 or so years with companies coming online that can handle that. Didn't, I don't think, really existed when you guys had first started, to have that option of real productized solutions that someone could go on one night, open an IRA, and then go and invest with you guys.
Yeah, I think we had a customer invest out of an IRA in 2015, and it was with Morgan Stanley, and it took a really long time, right? It took calls with Morgan Stanley on, they said, oh, we're the shares custody. And I said, well, it's a digital share certificate. Okay, so who's the custodian? There's no custodian.
Yeah.
But now you've got solutions, right? Like you said, there's Alto IRA, there's Rocket Dollar, there's a number of them, and we see them used with increasing frequency. So I think adoption there is growing too.
Yeah, very interesting. I want to talk for a second about QSBS. It comes up a bit when you have early employees or even really early investors selling on the platform. Is it, in terms of educating folks on the implications of participating in these private secondary markets, either on the buy side or the sell side, how much of that burden do you guys take on yourself to sort of educate folks about what options are out there, what sorts of considerations they might need to make from a tax perspective or otherwise? Or do you kind of, step back a little bit from that?
We'd probably be more in the latter camp, where we step back. I think we consider ourselves experts on how secondary transactions work, how we can make them as efficient as possible and as affordable as possible. We don't offer tax advice. But having said that, you can certainly see when certain people are looking to make sales, right? Secondary sales in connection with some QSBS benefit. And we talked about this one time a little bit before, Brady, which is, we'll have an angel investor, a founder, someone that says, now I am looking to sell my shares. It's been 5 years. Or no, I have to wait on this transaction because I need to get to 5 years. And so we see that come up quite a bit. I'd say the most common users of QSBS for us are probably angel investors that knew when they made their investment what the company's valuation was, and it was under 50 million, knew that they owned those shares for 5 years and knew that they would be eligible for QSBS. They'd probably have to get a letter attesting to the fact. And so we've seen that happen. It was probably something we really didn't hear of until 4 or 5 years ago, and it's become much more top of mind. And founders in particular, like we've seen people with strategies that suggest that they're very aware of QSBS, right? So they're making a sale on EquityZen, and the sale is coming from their name, trust number 1, trust number 2, LLC number 3. And so to me, that's usually a real leading indicator that someone's done some comprehensive estate planning. For early employees, a little bit less so. But the nice thing is, if you didn't know it existed, it's kind of a free option, right? You had the shares when let's just say you're an employee, you were issued stock options when the company was really small. If you were wise enough to exercise them the second you could, and the company was still sub 50 million, you've held those shares for a while, you may have a really tremendous tax benefit on your hands. And so I would hope, it's really the onus of that person's CPA to alert them to, oh, you sold these shares. Let's look at what type of taxes you're subject to. Is there an alternative minimum tax to look at? Is there a QSBS exclusion? We don't get into it too much. I'm like fascinated by it because I think it's truly one of these like mega benefits, right? Like at scale. Selling $10 million of stock and paying no capital gains and no state capital gains taxes in like some of these states is like you tell me, I think it's like a 26, 27, 28% benefit for some people.
Yeah, I mean, $10 million in New York could be up to like 37%. So you're talking, $3.2 to $3.7 million if you're a founder paying taxes in New York.
Yeah.
And then, I mean, just the federal benefit alone can be 23+%.
Right. Right. So I think there aren't many, to my knowledge, again, not a tax expert, not tax advice, et cetera, but to my knowledge, there are very few bullets to fire for tax benefits at that scale, right? In the millions of dollars, right? With the exception of maybe some gift tax exemptions like lifetime, but like for a single transaction and then being able to do it again and being able to stack it with trusts, like that is pretty powerful. What I would expect to see happen is much like where you're working on, which is how can we make sure more people benefit from QSBS, whether it's a rollover or with stacking. My hope is that it becomes a bit more readily available to people that might get $1 million of benefit out of this thing, right?
Yeah.
Some employee that, if they don't have a private banker or something, maybe they're not even going to be aware this is possible because the cost to build it out from an estate planning perspective can be like, 6 figures. But I think that's going to drive down over time, which I think will be good.
At the core of what you just said is more employees need to be encouraged and educated that early exercise, for instance, could be an option. More companies need to make early exercise an option because some make that more or less difficult for their employees. Now, not every employee at every startup should exercise their options, but many can afford to and have the opportunity to early on. If I don't think you would be at that company if you don't think that there could be some benefit. So probably good to exercise as early as possible. And if you don't want to exercise, probably ask yourself, why wouldn't I want to exercise at this stage? Those are good notes. We're super interested in the education piece because, like you said, we're in kind of a QSBS boom right now. But before this time, it was really just venture investors, a handful of founders, and like 75 CPAs who really were up on this. And now we at least talk to founders and they can say QSBS stands for Qualified Small Business Stock.
It's a good start.
It's a way better start than I understand it used to be. So that's funny. Maybe not a total last question, but last sort of big idea question. Interested in what kind of institutional interests you guys see on the platform? Is it mainly individual angels coming in and maybe buying shares? And you talked through a little bit about who transacts, but like funds and other types of investment vehicles coming in to transact on EquityZen?
Yeah, actually, quite a few more players than you probably had a decade ago. If you think about what else has happened in venture over the last couple of years, a lot of companies raised ungodly amounts of money in 2021 at really crazy sky-high valuations, which is kind of understandable. Someone wanted to give you $500 million to make you worth $10 billion and you're only doing $100 million in revenue. You probably took it. One of the consequences of that was in 2022 through 2024, a lot of companies just didn't go raise more capital because they didn't need to.
Right.
And they also were concerned if they raised money, it was going to be at $4 billion instead of 10 or $6 billion instead of 10. And yet at the same time, you had a lot of institutional investors that had a professional mandate to invest in this space, mostly venture capital funds, growth equity funds, crossover funds. And you also had family offices, you had RIAs that wanted to invest in these companies. When those investors would reach out to private companies and say, we'd like to be considered for your next capital raise, the company would say, that sounds great, but we're not raising money anytime soon. That led institutional investors to think about how else might they be able to make investments. And so that sprouted up a much more increased interest and focus on secondary transactions in lieu of making primary investments, right? So if you think of like a fund like Tiger Global or something, they wanted to continue to invest in great late stage private companies. Those companies didn't want to raise money, so they started looking into the secondary space to buy shares. So there's a growing cohort. There's also dedicated funds that only buy secondary transactions because they believe they can buy them at discounts to current or prospective fundraises. You have RIAs that are starting to put together vehicles on behalf of their clients because clients keep asking them, I keep hearing 60-40 is like a horrible way to do a portfolio. What kind of alts do you have? Like, I want to go to this dinner party and say I invested in like Anduril or SpaceX. Yeah. And so you have RAs that are asking more about it. So it's really kind of like the full gamut of investors. You got public funds now that have a sleeve dedicated to private investments that are making secondary investments. So certainly a growing topic of discussion.
Yeah, and I think there's even a ETF, like a private company stock ETF.
Now, there is one that I know of.
Yeah.
Destiny XYZ. Right. And then there are a couple of registered funds that I think operate more like interval funds. So it's kind of like a mix between an ETF and a mutual fund that have investments. So ARC Ventures has one, like Cathie Wood family of funds. So there's a few others. So certainly more eyes on it than before.
Sure. Yeah. Good insight. Coming up to time here, just thought maybe we'd close on a little bit of advice to founders. Folks will listen to this episode and check out your track record and what you built at EquityZen and think that, hey, this is, someone I want to emulate, had a lot of success. And so I wondered if there was anything in this moment that you would offer to a founder by way of advice on focus here. Hey, remember, don't lose your shirt here.
I have a lot of advice. I don't know if it's going to be useful. So if I were to try to narrow it down, I'd say I'll give an example. So I EquityZen started in 2013. We got into one of these accelerator programs called 500 Startups, which was awesome. It was a great experience. And there were 30 companies in that cohort in 2013, 2014. I think we're like the only company still around. And it's not because we raised the most capital or had the best product. I think it's just that we just kept working on it. And so I guess my advice to founders is that you just keep making a little incremental progress and keep working on it.
Yeah.
Don't go chase too many shiny objects. Know what you're really good at. That should compound over time. And I would also say that whether you're in tech or not, if you just treat your customers really, really well, listen to them, build solutions, they have problems, build solutions for their problems, like there is a business there. And it might not look the same than how you started on day one, but I think that's like the best advice I can give is if you treat your clients like they're your clients and you'll do anything for them, you usually can build a business around that.
Yeah, it's much easier to build a relationship with 10 people and then solve the problem that they all face together versus try and reverse engineer it and then find a customer.
Totally.
So
agreed.
Yeah. Thanks so much, Phil. This is really good insight. Super cool what you guys are building. Hope you
appreciate it.
Have a ton of success over the next couple of years.
Thanks, Brady. Likewise.
Right. Yep. Bye-bye. Thanks for listening to this episode of QSBS Solved. We hope to hear from you soon. Remember that the content shared on QSBS Solved is for informational purposes only and should not be construed as legal, tax, or investment advice. While we discuss strategies related to qualified small business stock, or QSBS, including rollover planning, listeners should consult their own tax, legal, and financial advisors before making any decisions. Laws and interpretations can change. Individual circumstances do vary.